All right. Let's get into the intricacies of depreciation. We were exposed to it a while back. And I was mad as heck at the book because it's like, what are you doing? We're not ready for this, but they gave it to us anyway. We now know that there's these 4 types of assets: land, land improvements, buildings, and equipment. Let's get to the right page here. We also know that they lose value, some more than others, some faster than others. Think about the cars you're driving. Are they worth what they were brand new, hot off the lot in their current year? No, not at all. So things depreciate at a variety of rates. Basically, the idea of depreciation is allocating an expense to the cost of the plant asset over its useful life. Okay? So the key that you need to know is that it's an expense of doing business to have assets that depreciate. You need to think of it as an expense, not a devaluation of an asset. So you own a school bus, it's going to lose value. Don't think of it as a asset that's going down in value. Think of it as an expense of doing business to have that asset. It applies to land improvements, buildings, and equipment, but not land. So if I've got this house on a chunk of land, wow, my pen is really off, but that's okay. And I put a fence up, and I put a light up, and I have my lawnmower. All the stuff above ground is going to depreciate. All the stuff below the ground won't depreciate. Does one of you mind shutting the door? Maybe slam it. So all that stuff, the house, the land improvements, the equipment, they're going to lose value. And we don't think of it as a devaluation of an asset. We think of it as a cost or an expense of just having that stuff. The land, though, itself, there's only so much of it. There's only so much land available in the city of Morris. Some have houses on it, some don't. There's only so much farmland to buy up, or so much hunting land or lake property to buy up. And so land actually appreciates in value versus depreciates. I just like this, whatever's above that land will lose value or consider it to be an expense of having it. It's depreciable because the revenue producing ability of the asset will decline. If I have the school bus, is the school bus going to last forever? No. And so its ability to produce revenue, in other words, get you to school so we can teach you, because you are our revenue, will decline over time. The grocery carts, you always get a bad grocery. I have bad luck. I always pull the bad grocery cart, the wobbly wheel or the one that won't turn. Okay? Those grocery carts don't last forever. And so they depreciate in value. And as they do, they lose their revenue building abilities. I like this visual. It should be in your notes, because the things that you need to think about when you compute depreciation is what did it cost, how long can we use it, and what's its salvage value that we can maybe get out of it at the end of its useful life. Notice that pristine truck, as it decreases in value, it gets more bumps and bruises. Think of it this way. Each bump, and I want you to start circling them. I see about 4 bumps on that as it cruises down its useful life. Okay, all these bumps. Oh, my pen's screwed up. Oh, it's even got a cracked window. Think of those as, I want you to draw a big pile. Think of all of these as expenses that get placed in the accumulated depreciation pile. So as it cruises through its useful life, a bump, a bruise, every year we expense out what it's devalued at. Where do we throw that bump or bruise? We throw it in an accumulated depreciation pile. The expenses, we know, belong on the income statement. Accumulated depreciation, you see on the balance sheet. I'll give you kind of an extreme example. Let's all take your vehicles that you drive. You literally don't yank the tail light off and throw it into an accumulated depreciation pile. You literally don't take off the hood and throw it in an accumulated depreciation pile. But to give you that visual, as it cruises down its useful life, you literally could think about taking a part off your car and throwing it in a pile. That's the expense, and as it gets to the pile, that pile builds up to what's called accumulated depreciation. Do you guys have the helpful hint in your notes? You might want to write that down, and it's basically what I just said. Depreciation expense is reported on the income statement. Accumulated depreciation is reported on the balance sheet as a deduction from plant assets, or what I would call a contra asset. So it's like me saying, oh, expense, throw it in my accumulated depreciation pile. Oh, expense, throw it in my accumulated depreciation pile. And as I do that, that pile is growing, but it's an expense of every year of doing business or having that asset. There's a lot of ways to calculate this. We are going to focus on 3. Straight line depreciation, units of activity, or double declining. Straight line is the most widely used, which simply, and we're going to go into the details in a minute, but every year it depreciates the same. Okay? Units of activity is how much do you use it? More of the seasonal things. Is your lawnmower depreciating every year the same? Well, it depends on how much you use it. So that's more of a unit of activity. School buses, they don't depreciate every month the same because June, July, and August, what are they doing? They're sitting in the bus garage. Okay, snow plows sit in their sheds during the non-winter months. So units of activity, but you know what, no, during snow season, they're getting hit hard. Okay, double declining, I always like to think of that as like vehicles. You've heard the age-old phrase, you drive a brand new vehicle off the lot, it loses 25% of its value when you leave the parking lot. Okay, I don't know if that's true or false, but that's a lot. And then it kind of, you know, think about a brand new $60,000 Suburban, okay? If I'd go buy that today and drive it hard for a year, it's going to shoot down in value. But then it kind of plateaus. Like, once it gets to that lost so much value, then it kind of, they're always kind of valued at the same price, basically. And we're going to actually run some numbers to play this all out. So let's take a look at Barb's florist is purchasing a delivery truck, okay? There's some factors here, just like what we got done talking about on this slide. We're going to take a look at its cost, its useful life, and its salvage value. So back to Barb. Barb's florist is going to buy this floral delivery truck for 13 grand. Now, historical cost principle says there's probably some stuff hiding in there. Have we had to pay sales tax on that thing? Yes. Have we maybe put stickers or done a custom paint job with the Barb's Florist logo on the side? Yeah, okay. We maybe had to get it installed and updated to be a floral delivery truck and just instead of a normal truck, okay. So there might be a lot of other things that have factored into that $13,000. That's what we did yesterday. We're saying, here's its price today. We are probably going to use this thing for 5 years, putting about 100,000 miles on the thing. And its expected salvage value, we're going to work that poor floral truck until it reaches a value of $1,000. What you need to know about salvage value is you can never let it depreciate below that. You better get rid of it before it depreciates below that. So what we're going to do now with this floral truck, we're going to run straight line depreciation, units of activity depreciation, and double declining. I wish it said double. And we're going to look at it 3 ways. And then we're going to compare the 3 ways by the end, which makes more sense. All right. Straight line. What you need to know about straight line is the expense is the same every year. Every year it's going to be expensed out as a depreciation, the same every year. We do have this little thing on your notes. Okay, good. The thing costs, no, you don't. Okay, well then you better start writing. So we take a look at the cost minus the salvage value to what's called the depreciable cost. We know it costs 13 grand, but remember, we're not going to depreciate it past $1,000 or past its salvage value. So we're calling the depreciable cost the difference. So with straight line depreciation, we don't care that it cost $13,000. We factor that into what we hope to get out of its useful life to be what's called the depreciable value. We take the depreciable cost then, as my arrow is showing, divide it by its useful life. Its annual depreciation expense, because remember that's going to be the same for each year, is going to be $2,400. Our $13,000 truck that we actually have a depreciable cost on of 12 grand, when divided over its useful life, it is going to expense out or go down in value every year by $2,400. So if I take year 1, year 2, year 3, 4, and 5, in year 1, it's going to go down by $2,400. We're also going to shoot that over to our pile. This is our accumulated depreciation pile. In year 2, it's going to go down by $2,400. Shoot that over. Now it's going to add to the pile. What's accumulated depreciation up to so far? Just after 2 years, our pile has grown to what? $4,800. After year 3, it's going to lose $2,400 value. Every year, this pile is growing. And I know you get it because it's the same every year. Pile's growing. Pile's growing. So this it's like I'm ripping something off as the expense and throwing it over in my accumulated depreciation pile. Okay? We have to figure out what's called the straight line rate. You take the annual depreciation of $2,400 divided by its depreciable cost. I thought the thing cost $13,000. Why is the depreciable cost $12,000? Got to factor in what we hope to get out of it. And this is going to equal 0.2. In other words, its straight line rate is 20%. It's going to lose 20% of its value every year. Now I want to show you this. What I just did with it looks like I'm making a giant rainbow here. I want to show it to you more in the math format. So are you ready for this? We know we're running this 12, not 13, because of minus the 1,000. We also know that its straight line depreciation rate is losing 20% of its value. We know that it's going to be $2,400 every year, but we want to show that in math format. You have this in your notes. Good. You have all the numbers though, don't you? Depreciable cost, and you might even want to put 13,000 minus 1,000 equals 12,000. So this was the cost. This was the estimated salvage value. How do we get our rate? Why do we know that it's going to be 20%? Because back here we figured out the annual depreciation divided by its depreciable cost was 20%. So if I take 12,000 times 20%, we know this is the annual expense, and that's going to be the same, and I draw an arrow like that. That's going to be the same year by year because it's straight line. It depreciates at the same rate every year. Here's where I'd maybe, if you have a highlighter, grab a highlighter. I'm going to take 12 minus what it depreciated that year. Oh, I'm sorry. I did that wrong. Hopefully you didn't highlight just yet. It's like we took this chunk and threw it in that pile. I want you to draw a pile here. So this is the expense. Here's our pile that's growing. Here's what I want you to highlight. 12 grand minus what it depreciated equals its new book value of 10,600. If we had to sell it right now after year one, we probably could get 10,600 for the thing. Year two, depreciable cost times 20% is still 2,400. Our pile is growing though, because remember, every year we're going to take the expense and throw it over in the pile. Now, we're taking a look at our book value minus 2,400. Now it's only valued at 8,200. Year 16, same 12 grand, same 20%, same 2,400 because it's straight line. It's straight line, it's the same. Is our accumulated pile going to grow though? Yep, by another 2,400. Is the thing valued at 8,200 anymore? No. We're going to see a decrease of 24 again. So right now, after year three, could we sell it for 5,800? According to this math, we could. You could bargain for higher, yeah. But this is what it's, using straight line is what its book value is. Year four. Has our accumulated depreciation pile grown yet? Yes, add another 2,400. On the other side, subtract the 2,400. Last year, 12,000, another 20% is our single rate. One last time, straight line depreciation says it's always the same. The pile is going to grow to 12,000, and this is going to go down to its estimated salvage value. If we had to journalize it for just 1 year, this would be the same year after year. This would be the journal entry that you would do just after 1 year. Accumulated depreciation expense goes up. Remember, that's an income statement thing. And then the accumulated depreciation pile that's actually up because remember, it's a contra asset. It's offsetting the value of our floral delivery truck. Okay? Because remember, our floral delivery truck is equipment. Okay? Or, I don't know, maybe we'd have a delivery truck account. So if I had to, let's see, I'll write up here. If we had our equipment, okay, I'll put our depreciable value in there of 12 grand. This would be the equipment dash accumulated depreciation of 2,400. So after year 1, do you see how the 12,000 minus 2,400 would be what it's valued at the end of year 1? So remember, even though this is sort of asset related, it's a contra asset that has a credit balance. So it's another way of looking at what it's valued. Ready to throw a curveball in here? Are you sure? What if we don't buy this on January 1st? What if we bought this thing on April 1st? Have we owned it a full year in 2014? No, we haven't. Oh, golly. It's still going to be this rate, you know, taking the 2,400 divided by its depreciable cost equals 20%. It's still going to go down in value the same every year. It's just that in year 1, we only owned it for 9 out of the 12 months. So we're actually going to make it look like it's going to still be 5 full years, but you're going to span 6 years. Because if you look, these are the full years. And then we have 2 partial years that equal 1 year. So in 2014, we had it all of April, May, June, July, so 9 out of the 12 months. That's a partial. And then we had it 1, 2, 3, 4 full years, but we needed that other year to finish out the 3 of 12 to get it back to that April 1. Does that make sense? It's just that you have to add this column of math in there because it didn't really depreciate 2,400. We're saying that's our expense, but it really only currently is sitting at 1,800 because of April, May, June, July, August, September, October, November, and December. So things get complicated when we buy it mid-year. In a perfect world, you'd buy everything on January 1, but that's not, we don't live in a perfect world. What do we think of straight line? So-so. Now it's time to look at this same truck, same delivery truck, but we don't really care about we're going to look, we're going to look at it from how many miles are we driving, okay? So we take a look at its total units of activity. And it's going to vary based on how much we use it. School buses are heavily used throughout the school year, not so much in the summer. Okay, and we still are looking for the depreciable cost. So it's the $13,000 cost minus its estimated salvage value. But this time, instead of dividing over how many years we're going to use it, we're going to divide it over how many miles we're going to put on it. Figuring out that each time we drive it a mile, it's going to cost us 12 cents, or it's going to go down in value by 12 cents. Then they're saying, okay, in this year, how many miles did we drive it? Well, in, let's just say 2014, we're thinking we're putting 100,000 miles on it, costing us 12 cents a unit when we do actually use it. In 2014, we put on 15,000 miles. So in 2014, its depreciation expense is going to be $1,800. Remember, that's the expense that we're going to chunk off and throw over to the accumulated depreciation pile. That will grow. Is there really an accumulated depreciation pile at a place where they've like literally taken off the steering wheel and throwing it over in a pile? No, it's a visual thing. It's not a visual thing, it's just I'm trying to visualize it with you. Okay, so let's try this. In year, I don't know, the book would have to tell you how many miles it's driven each year. So we know that it's 12 cents per unit because if we go back, we took the depreciable cost, so 12,000 divided by the estimated miles. So instead of how long are we going to have this thing, how many miles are we going to drive it, getting us to the 12 cents. So if in year 15 we drive it 15,000 miles, it's like for every 1 mile it's costing us 12 cents, we're looking at an expense of $1,800. With nothing in the accumulated depreciation pile yet, what is accumulated depreciation going to be? $1,800. We take now the 12,000 minus its depreciation to equal the difference. If we had to sell it after year 1, there's what you'd have. Now in the book, in the test, in the problem, it would say in year 15 we drove it 30,000 miles at our 12% rate. We're going to see the expense shoot up. Remember, straight line was the same no matter what. Units of activity is how much are you using the thing. We already have something in here. So 36 plus 18, we're actually going to have a $5,400 accumulated depreciation pile. We're going to take this book value minus 3,600. Thing's only worth 7,600 after 2 years on an item that was 13,000 originally. Let's say in 2016, again, the book would tell us these numbers. We take it times, in 2016, it's a $2,400 annual expense plus what was already there. The accumulated depreciation pile is now up to 78. So it's a little bit all over the map, but it's more accurate on how you're truly using it because it's per mile. Okay. So remember, here's the expenses that are showing up on the income statement every year. The accumulated depreciation pile grows every year based on what happened under the expense. You take 7,600 minus the expense, its new value is 52. Keep going for another year, times 12 cents a mile, okay, plus, let's add to the accumulated depreciation pile. Woo! 52 minus what it depreciated equals 22. Next year they're saying 10,000 miles were only put on at 12 cents a mile. We've now reached our salvage value. Probably time to sell it. Because its book value minus what happened this year equals $1,000. Way back in year 2014, we see this happen. Okay. Remember, this is a contra asset, hence the credit. Which cost us more? Straight line or units of activity? Same truck. If we have a straight line depreciation method, wasn't it $2,400 a month? If we have units of activity, like only how much we use the thing, it was dramatically less. Doesn't this one make more sense? Like how much you use it is how much it depreciates by? Well, for a truck, absolutely. For a truck that's used seasonally. Double declining. This is definitely the accelerated method, very true to vehicles, things that depreciate super fast. It's twice or double the straight line rate, hence it's called the double declining balance. Well, we knew the straight line rate was 20%. Remember calculating that before? Well, we just double it. The big difference here is we look at book value, not the depreciable cost. We bought the thing for $13,000. We use $13,000. I think that's a little dirty of them, but so we've been 12 because of the estimated salvage value. We don't care about that. What'd you buy it for times 40% or double the straight line rate? So if we had to look at this, okay, it's double. We don't care that it was 13 minus 10. This was what we bought it for, or the cost, not the depreciable cost. Times 40%, holy cow, a $13,000 delivery truck is a $5,200 annual expense, gone. It's like we took that chunk and put it over in this pile. 52 plus nothing is 52. Its book value, though, at the end of the year, 13 minus 52 equals $7,800. We had to sell it after year one. It's worth a lot less. Now here's the new bit. You take that 78, and that's the book value starting the next year. Before it was always 12, because we're always hoping to get to that $1,000 salvage value. Here, you don't consider that salvage value. Instead, what'd you buy it for? What did it lose value on? And that's your starter for the next year. Times 40% equals, now its expense is $3,120 because the thing's older. Add to the accumulated depreciation pile. But 78 minus 3,120, after year two, it's down to 4,680. What are we going to do with 4,680? That's going to be its new book value at the next year, again, times this double declining rate. So you see the expense go down because it's only based on a smaller value. Add into the accumulated depreciation pile, but subtracting from its value. A $13,000 delivery truck is only valued at $2,808. To me, this makes the most sense. Vehicles lose value quick. But what's happening is, do you see how it's kind of plateauing off? You see it's super, this is where we're going to start actually tomorrow. Remember what I said when I talked about salvage value? You can't let the thing depreciate more than its salvage value. So we were dipping close to that 1,000 mark. So this is starred because we have to adjust it. We have to get our math adjusted because we can't let it dip below $1,000. So this is forced. This is where I want to pick up tomorrow. I want to show you something in a minute. Well, we'll stop there. It definitely plateaued off. That's the main thing that you need to know. Lost a lot of value in the first couple of years and then kind of plateaued off. We will pick up right where we left off tomorrow. You guys did a great job.